Let's break down one of the most important formulas in finance, the capital asset pricing model, or CAPM. This model basically answers a simple question. If I take more risk, how much return should I expect? And the answer becomes the cost of equity, the expected return investors demand. So KPM has three parts. First, the risk-free rate. This is the return you get without taking any risk. In India, the 10-year government bond yield is commonly used. Think of it as the baseline, the return for doing absolutely nothing. Second, we have the market return, what investors expect the overall stock market to deliver. And when you subtract the risk-free rate from the market return, you get something called the market risk premium. This premium is the extra return the market gives you for accepting market-wide risk. And then comes the star of the model, beta. Beta tells you how sensitive a stock is compared to the broader market. If the market moves 1%, how much does the stock move? A beta of 1 means it moves exactly like the market. A beta greater than 1 means it is more volatile, higher risk, higher expected return. A beta less than 1 means it is more stable. Now let's understand the CAPM formula in simple words. Expected return is equal to risk-free rate plus beta multiplied by the market risk premium. That's it. It's actually very elegant. Now let's bring this to life with a real example. Let's take Tata Motors, a stock many Indian investors know. Assume the risk-free rate is 6%. The average market return expectation is around 12%. And Tata Motors has a beta close to 1.7, meaning it is more volatile than the market. So here's how we do the calculation. First, compute the market risk premium. Market return minus risk-free rate, that's 12 minus 6, which equals 6%. Now multiply this by the beta of 1.7. 6% times 1.7 gives 10.2%. Now add back the risk-free rate of 6%. 6 plus 10.2 equals 16.2%. This tells us something powerful. For a stock like Tata Motors, with higher volatility, investors expect around 16% return per year to justify the risk they're taking. That number, 16.2%, becomes the cost of equity for Tata Motors when analysts build valuation models like DCF or FCFE. And that's the magic of CAPM. It connects risk with reward in a clean, logical, and practical way. Whether you're analyzing stocks, valuing companies, or preparing for NISM, understanding CAPM is non-negotiable.